Hello and welcome back. I'm Natalie MacDonald and you're watching Dukascopy TV. Up next, we're talking structured products. I'm joined by Sacha Duparc of BCV. Sacha, thank you so much for coming in and seeing us again.
Well, thank you, Natalie, for having me here today.
No problem at all. Okay, so what role, firstly, do structured products play in an investor's portfolio, and how does it fit into strategic asset allocation?
Well, structured products are really a combination of different elements, and therefore they can be tailor-made or customized as a function of what the client really tries to achieve. Now, you can go into structured products whether you think that the markets might go up, might be stable, or might come down. There is a solution for you that we can customize. So the really interesting part about structured product is, or let's say in a strategic asset allocation, it gets interesting to go into this asset class because let's say that the expected risk-adjusted return that you would expect from the underlying might not be that attractive. But when you restructure it and basically compose a product with multiple options, and you will basically define a path for the underlying to best exploit, that's where structured products get really attractive. And I guess the main idea is to customize something that will allow you to get the maximum expected return under certain conditions that you wouldn't have by investing directly in the underlying product.
Now, structured products payoffs attractiveness is linked very much so to current market conditions. With that in mind, how have central bank policies influenced this segment of the investment universe?
Well, as Schumer, I believe, said to Ben Bernanke, he said, "You are the only game in town," right? So interest rates having come down and all these very aggressive monetary policies have had their toll not only on interest rates, but also on credit spreads and also on equity valuations. So what you see right now is that credit is pretty rich. Equity valuations also by historical standards are pretty elevated. The corollary to all this is that implied volatilities have come down, as well as realized volatilities. What does that mean for structured products? It means that there's less yield to be had for people looking to sell puts or sell calls. But that doesn't mean there are no solutions that might be of interest to our clients. Another a corollary to these very cheap money policies is that correlations have remained pretty high across assets and especially in certain segments of the market. So that's when you look at all these parameters, you have to have let's say a framework to think about all these parameters and how do they all come together to really build the best product that you can, given that what the market is currently pricing. One additional thing that's also very interesting, I believe, in the market is the level of the skews on the implied volatility surfaces. What those are telling you is that the market think that we are in an equilibrium at this point, but this is a transient equilibrium. So the market is still pricing a lot of risk at the tails. Therefore, they don't expect much volatility in a local fashion. They don't expect prices to move much if there is no shock. But if there was to be a shock, then the market is pricing a huge swing, whether to the right or to the left of the probability distributions. So all those parameters have to be kept in mind. Basically, implied volatilities, the levels of the markets, the shape of the skews, as well as the correlation levels.
So in this context, how can one capitalize on current market parameters, and what specific structure or payoffs do you see as being attractive?
Well, I would say that Swiss clients are used to selling volatility. They're used to selling puts through what they call barrier reverse convertible type structures. At this point, as we said, I mean, the volatility is just not there anymore. So it is, from my point of view, a bit dangerous to keep on selling something that is cheap. But it doesn't mean there are no structures that might be of interest to clients, especially if you think about capital protected structures. There's not much interest rates to be had at this point, yet it's still interesting to go into products that will offer you capital protection because the value of those calls are pretty cheap. So you can participate participate in the marketplace or participate to the appreciation of an index, let's say, for a rather attractive premium. Also, we talked about skews. You can refine this type of products by selling out of the money calls. So you would be long at the money spot calls, short out of the money calls that would come and finance part of your long leg. That I believe is also attractive at this point. So all products that would basically capitalize on the shape of the skew at this point are interesting, but I would think that selling volatility is just not a very attractive does not have, let's say, a very attractive return versus risk balance.
You were also mentioning other factors such as correlations across assets remaining relatively elevated. How can an investor with a tactical approach profit from those parameters?
Well, that's an interesting question because at this point, I believe some of the best structures that can be had at this point are long-short type structures. So what I would say a smart investor would be to do at this point would be to buy, let's say, a basket of pharmaceutical companies that might be the prey of M&A activities and short potential acquirers. Why is that? Because correlations are pretty high, or let's say that they are priced pretty high in the marketplace. That means that those calls would be pretty cheap. If you buy a call whereby you will profit from the outperformance of potential targets of M&As and be exposed to the short side to the acquirers, could pay out handsomely in the end. So you have lots of tactical investment ideas that can be implemented through structured products and that offer at this point very attractive payoffs given relatively high correlations and the fact that they don't quite price potential dispersion at this point. So low volatility and high correlation makes for great thematic type investments in the structured product space.
Sacha, thank you so much for coming in and sharing your insight with us. A pleasure to receive you again.
Well, thank you again for having me here.
No problem. That's all we've got time for right now, but do stay tuned. The Dukascopy TV team will be bringing you all the very latest in FX analysis and updates. For now, though, it's goodbye.